As we turn to the U.S. and refined products, we always like to start off with the total consumed products from gasoline, jet fuel, distillate, residual. And again, those are the mobility fuels. So when you look at last week we had a demand of 14.39 million barrels a day. And here we had 14.31 million barrels a day. And one of the things that we've talked about, and you can see the spike, in 2021, we had that big spike up driven by gasoline demand, as we also had trucking demand. But typically, and you can see it again in 2018, so we normally get a spike. So we should get a one more increase because that gasoline number is still on the low end compared to where we were for the driving season, because Labor Day is the last hurrah. People drive around, take a long weekend, and then things get back to normal, if you will, as school has officially begun for everybody. My two older girls are now in school officially full time. My wife is gonna know what to do with herself. She'll have my youngest for 2 out of the 3 days, so she'll still have some companionship, but things have start to get a bit normal. But now when you look at this, you can see that even if you get a big increase in gasoline, just to true up some of the numbers, you're still at a very low end in comparison to 2021, 2017 through 2019, and then obviously last year. And we don't really see that changing because even though things were reduced across the board for 2021, diesel was not. Diesel was the driver of this, and that is not. Diesel's still strong. There's still some demand there, but not. But again, the gasoline has come down a bit. And even though we've seen people talking about how gasoline prices are coming down, this puts more money in people's pocketbooks, but diesel prices haven't. And again, that is a huge driver of cost throughout the supply chain. So yes, gasoline, you can feel it, you can touch it, you can see it because you're the one paying for it, where diesel, again, continues to contract, and that adds up. So even as we go through, and as we've been saying, we expect the average to be at about 14.5 to 14.3 million barrels a day as we go through the remaining months. Distillate, small build of 90,000 barrels, still not what we need. 33.9 million below the 5-year. The benefit was we got it. We did get a build in pad 1 of 1.23 million. That's a positive. Still 20 million below normal, but again, that is still a good thing, with pad 3 having a drop of 1.39 million. So the goal is to get that to flip as imports came down slightly of 36,000 barrels a day. We do expect that to remain close to the 5-year average because pad 1 still remains a good place as an import destination, because even though we're getting some builds, you can still see the rate of change. The builds, one, should be faster than they are right now, and we should be at a much higher rate than we are right now. So again, even though we're getting an increase, we're still well below where we need to be for just normal heating burn. And it comes down to what is Mother Nature going to throw at us, because this is going to weigh and support pricing, especially in pad 1 and the East Coast as we head into the winter months. Pad 3, on the other hand, fairly stable. Obviously, a lot of lumpiness when you look at 2022 so far, but fairly stable. Like as we've been saying, pretty flat for the most part, because you don't have an easy route of going from the Gulf of Mexico into pad 1. But there is a very healthy market abroad. So you're seeing some of that managing of, well, what is storage like right now in the U.S.? What is the opportunity abroad? Distillate storage in pad 3, it's about 7.3 million below the 5-year. But you can see it's still above the 29-year average. There's still some mobility and movement. And then when we look at production, production continues to remain weighted towards the disty front, making about 31.6% of the yield going into that, 61.6% going into gasoline. So it's still trying to, again, maintain and try to push some of that distillate production, because that is where the margin is as the gasoline crack continues to weaken in general. Distillate demand in the U.S., you can see, still remains low. It's, as we said, it's going to be at the 5-year or just below, at the low end of that cloud. just because we still have trucking demand, but a lot of that other ancillary piece still continues to be a bit depressed. And here's where we're starting to see some of that flatlining for trucking. There should be a bit more support as we get further into, we had back to school, so you had a lot of that inventory come down, start to see some of that build back up, and then we were obviously preparing for Halloween, and then the big push for the holiday season between Thanksgiving, Hanukkah, Christmas. Obviously you're going to get some of those moves, but again, it's not going to do much. It's just going to keep us. There's some tailwinds there, but the headwinds are real. We don't see a big spike. It's just steady as she goes at these levels. And what gives us confidence in saying that is looking at what is coming into the U.S., which still remains at the lower end versus the previous year. You can still see that it's low. It's still above what is deemed normal if you average out the previous, the 5 years prior to 2020, but you're still at an upper end, just not like where we were in 2021, which is why you're going to see some of that depressed moves versus last year. There is some reprieve coming into the West Coast after some big heat waves caused a lot of panic in terms of potential rolling brownouts. You can see that there's some cooler weather coming into essentially the Mississippi, that whole region, with some above temperature levels, but again, nothing too crazy. It's not like we have these massive heat waves, but there is some heating up in the Midwest. That could create some dry conditions when you're looking at the harvest and kind of that last push for yield. So again, that will weigh on things a bit. But when you look at this in general, natural gas demand should be fairly stable. I think pretty close to where current estimates are. We don't see a huge surge in demand higher, a huge surge demand down. It's just going to be fairly stable as we get into and further into the fall months. So gasoline storage went up 330,000 barrels. It's still 15.8 million below the 5-year, but when you look at it against last year, that flatlining, you can see that on the 29-year average, that dotted line, you normally have that continuous decline, which we're just not getting. As we were saying, fairly flat. Blending components was down 0.03, so 30,000 barrels, nothing too crazy. And a lot of that was driven based on imports, with a big spike in imports into the PADD 1 of 439,000 barrels a day, getting us to about 336,000. Gasoline total imports of 447,000 barrels a day. That's over 1 million barrels per day. And that's something we should get a little bit more of a tailwind. It'll come down week on week, but it'll still be above the 5-year average because we do have some behind that. There's a lot of product that is still coming from Europe. Some of it actually made, as we said in segment one cargo actually made a U-turn, is going to West Africa. So we're starting to get some of that balancing act into PADD 1, which had a build of 1.53 million, which is still 9.1 million below the 5-year, but again, getting to that more of a stability side as we come into a slower demand period following the last hurrah of the Labor Day weekend. So just looking at it in general, you can see again the drop. So we expect to just continue to go sideways, and seasonally speaking, and especially from the months that were above us, the years that were above us, you had that strong drawdown. So again, we're gonna consolidate as we get into the beginning of October. And as storage looks a bit more normal, demand still remains a bit on the lower end. That's going to put more pressure on pricing and again hurt that gasoline crack. Right now, the distillate crack, no problem carrying the gasoline crack, but that's not the case everywhere. We're starting to see that creep into where the gasoline crack has gone negative in Asia, and that's again pulling down some of the economics and will result in additional run cuts if we continue to see it go down this path. Now, when you look at Chinese demand, this shows it coming down. There's actually been a bit of a spike back from these lows, even though there's been some additional lockdowns. Now, I think there's a mixture within that, because the lockdowns have been announced. Some of them have been extended. So there's a bit of a panic to rush out, get what you can, then go home. So we do see a spike and then a fade on the Chinese demand. On the Google mobility side, things still remain very strong, especially when you're looking at the Asia Pacific. And it's funny because the numbers show something, especially on the physical market, are showing declines and weakness in terms of pricing, but then the mobility is showing still some strength. So it's going to be interesting to see how that disconnect goes, and are we going to see a bit more of a drawdown as we go on the storage side, because we did see some pulls from Singapore. We did see Fujairah come down a bit. But then when you look at pricing, it's actually gotten weaker, even though this is going to be an important one to watch, especially Europe. When Europe had a nice little surge into the end of summer, we do expect it to level off a bit, but just obviously below what is normal, as things in the Americas have leveled off at this point and should come down a bit, but remain fairly stable just below normal. So now when we look at pricing, this is obviously helping. Gasoline is down to $3.75, but diesel's still staying over $5, sitting at about $5.04. Now, obviously, crude prices have come down. That will help. But diesel has those unique features on a global basis, not just in the U.S. The U.S. is obviously very short, especially in PADD 1. We're seeing shortages remain in both Europe, in Fujairah, as well as in Singapore. So there is a lot of staying power for price, where gasoline continues to have that overhang. We're either at or above all-time highs on a seasonally adjusted basis in Europe, in Singapore, which is helping to keep prices coming down on the gasoline front, even as crude hangs in a bit at about 83.5. You're still going to see some of that downward momentum on gasoline, but not the same on the diesel front. Now, when we look at blending components, as we're seeing some of that flat line, you can see that there's usually those drawdowns that exist until about the beginning of October. We think it stops a bit earlier and starts to flatline here, and we will start to see that creep back up as we get in further into winter. Now, when we look at demand, as we said earlier, we normally get a spike, and we think that we're closer to about 9.1, 9.2 million barrels a day. But we normally get that spike and fade, and then there's that again holding at that lower end, and we see that still being the case, being at the very low end of that 10-year average, on the low below the 10-year average, just giving you an idea on where gasoline demand is now versus historics. Even as prices get better, it's just, prices are getting better, but I have nowhere to really go. I'm going to work, but not working from home is still 2 to 3 days out of the week, which is going to keep that a bit on the lower end. And here's where you can see that some of that pull down. Obviously, workplaces had a small dip just because of the Labor Day weekend, but you can see that workplaces still, and it'll get above 20% below normal. But that's where it's going to hang out. It's going to stay below, about 18% below normal on average, just given the shift in work schedules and that flexible schedule, as people still try to avoid some of the different pieces on the retail side and the recreation front. So then when we start looking at propane, propylene, build of 1.89 million, 6.8 million below the 5-year. And as you can see, it's just tracking. We normally get those builds. The rate of change has been fairly consistent. It's right around where we were in 2017. We still see a good backdrop as we progress into fall and into winter, given where external demand is, where imports are, as well as local demand. Jet fuel had a small build of 160,000 barrels. That's just 2.4 million below the 5-year. But when you look at demand, we had that drop. You can see it happens every year. So it's right in line with the seasonal drop. We just think that it starts to consolidate, as we've been saying, that 1.45, 1.55, and we just hang out at that level as we go through the remainder of realistically the rest of this year. We will get spurts, obviously, in Thanksgiving and then for Christmas, but we think that realistically, on an average basis, we're in this, let's call it the new normal of that 1.45, 1.55. And here we had that spike, and you can see that for 2019, it was almost like a week earlier. You can see the same spike. Here we had it, now we're falling back down, and we're just going to remain between 2021 and 2019, just kind of filling in that little void and coloring in between the two, because we're going to have lower highs, lower lows versus 2019. But then when you look at against 2021, higher highs, higher lows. So again, filling in that void between the two. As we get schedules ahead, 0.65% lower. So we still get a little bit of this creep down. We see that continuing as we progress through the remainder of the year. There's a seasonality on top of just people doing a bit less. And we think that that's going to be consistent as we go through the rest of the fall and winter. Open table starting to turn down just a touch. Obviously, there's some noise in that given Labor Day, but as kids go back to school, people are, it gets a bit colder. We will see some of that drift back down, and again, it'll be interesting to see, because even though we've seen some dip in other data sets, open table has been showing that things have been fairly stable. And it'll be interesting to see as this all shakes out, how much of this is because open table is being used more often, or it's easier to get reservations, and people are, they feel more confident that they can go on and get it. So it'll be interesting to see how this data starts to jive with itself, because I want to look at this compared to some of the other ones on restaurants being visited, because that looks to be going down based on credit card data, while this is showing things fairly strong. But again, down is relative. Like even the credit card data still has it down 3%. So to see that down 3%, but then the U.S. down up 5%, I think that kind of marries. But that's going to be one to watch as we go through the remainder of the year and seasonality kicks back up. So that's what we have for you for the U.S. We still think that there is a lot of overhang for gasoline. We're still on the bullish bent for the diesel side, and we don't really see much to change that direction at this point in time. Now, in the next segment, we're going to go deeper into some of the lockdowns in China and how that's going to kind of shake things up as we go into the rest of the year.